Episode 565, Trading Justice Podcast. Super Bowl Sunday. Every day's the Super Bowl for Bulls. Matt, 14 out of 15 weeks up. You know, that doesn't happen every day. That doesn't happen every year. We'll talk about what's fueled the rally.
You know the market's not rigged. We do have one red candle in the last 15 weeks.
You know, and so it's
rigged if we have a red candle.
Like literally historic rally. You know, like you and I were very bullish at the bottom, but nobody is going to say, you know, it's hard to call, hey, this is going to be one of the biggest rallies ever in the history of the market, which it has been. It's been pretty insane, but we'll talk all about that. But Matt, how you doing on Super Bowl Sunday?
Doing good. Excited to be here to record another fantastic edition of the Trading Justice Podcast, and excited to be here with with you, my friend, to break it down all the market activity last week, and looking forward to the market activity this week. We like to do a little bit of a lay of the land type podcast, kind of look at what transpired last week, get our community ready for what is going to be coming at us in the next week. And then we like to have a detailed conversations in the podcast that we don't usually have in, say, for example, the halftime report or any of our other content and tackle trading. So excited to be here. It's been impressive, to say the least, watching the price action. But as the market continues to climb, at some point, don't you have to start getting a little concerned about froth at the top, a little bit of exuberance, irrational?
Well, I think you have to. Okay, we'll get into that in a second. I want to start with something else.
All right, you point, I trigger. Let's go.
What is the thing you are most confident in on the Super Bowl today, from a betting perspective?
Oh man. Oh.
Because I got mine, and I love mine. I have a max.
Whatever the over-under on Taylor Swift.
Yeah, you stole my thunder. You know,
like whatever the over-under is, take the over.
No, take the under. I have it. I don't care. Here's the thing. I got a $10 bet.
Show Taylor Swift on Super Bowl?
No, they're going to show her, but the speculation, they're going to just show her nonstop, and the hype is too much. Right. And so you got an inflated betting line, like, you know, because everyone's like, they're just going to show her. They're 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 going to show her.
Do you think there's a little bit of too much?
Oh yeah, dude. This one's a max bet for me. Like, Vegas, I think
has over evaluated this.
No, Vegas has correctly evaluated the public's hype on this. That's at too high a line.
All I know is there's a line that Taylor Swift and Travis Kelce will announce that Taylor Swift is pregnant, and that is plus 2,200.
Yeah, no, like, listen, you fade the Taylor Swift hype.
I don't think you fade it. I think you can rinse and repeat this technical conversation of the S&P 500.
Like, there's too much hype. You know, it's not that Taylor isn't awesome, but there's just too much hype. So that's the bet I'm going to do.
A couple numbers to kind of push back on that under bet out of you. The Kansas City Chiefs have made over $300 million from Taylor Swift influences. Just over $300 million. It's untold what it has represented for the NFL in general.
Oh, NFL likes some Tay-Tay.
The NFL loves marketing too. They love marketing too. Do you really think the NFL is not going to try to showcase Taylor Swift?
See, but this is public information, and this is the kind of stuff I hear out of overbetters.
I don't think you're underestimating the willpower of the NFL to use what they have in their moment as much as they can.
I am max bet on Gino. I got Gino on the hook for $10 that they'll show her over 10 times. And I'm like, there's no way in the universe they are showing her over 10 times. So we will find out if I am fading a SPAC.
You're
purely.
You're fading Microsoft right now, bro.
No. So no, I feel strong about that. But what about the game itself? Who are you rooting for?
Rooting for. I'm rooting for the Niners. Like I think we're all rooting for the Niners here. for a variety of different reasons. My number one reason to root for the Niners is Davey, our brother. He's a big time Niners fan, and I like to support our brother's team. So that's the number one reason. But I do not want to see 14 straight days of conspiracy Taylor Swift theories in the Kansas City Chiefs, and so I'm cheering on the Niners for a variety of reasons here.
Okay. I just don't care. Like I like Andy Reid. I respect Kansas City. I like the Shanahans. Always been a Shanahan family fan.
Kansas City, good players, good team, good organization.
You know, so I will root for San Francisco begrudgingly just because they've won it less. When's the last time San Francisco won it? Like it's not, you know, we don't have a real
We're
underdog.
not going to feel bad for San Francisco's legacy here,
yeah,
in the NFL. But I will say this in terms of my typical stance. I usually do because it's Miami or bust for me typically, which means it's always bust. But I typically find myself cheering on whoever's losing at halftime.
You know, you want a good game. That's what, you know, like
I cheer for good games.
Last year I felt the same way. You had two good teams. I was rooting a little bit for the Eagles, but I just wanted a good game.
We've kind of been spoiled with good Super Bowls recently too. There was a stretch back in the 90s. We didn't get a good Super Bowl for a while. It's been good to see some competition at the highest level of the NFL. So I'm excited for the game. Let's see what happens, but go Niners tonight.
Yeah, I mean, nice to see some competition in the stock market, but that's not been the case. It's been, it has been one way all the way. And Matt, you shared an interesting stat with me because, you know, as far as we had a very light week last week in news, some Fed speakers out there, not a lot, a couple of nice treasury auctions that bond traders might be interested in, but it was kind of a boring week, which I think we needed in the midst of everything going on. But you shared an interesting stat about how far the market had turned up versus how far EPS had turned up. Well, we share that stat with everyone because I just found it really interesting as a consumer of information.
Well, I think one of the concerns I think a lot of people have outside of the short-term technical conversation, which is a conversation swing traders just really dominate that conversation. And so this is not a conversation for the swing trader who is going to follow the trend until the trend is not their friend. And that's just the trend's been the friend for 2.5 months now. We've been dealing with recent breakouts in the market. I don't feel like the short-term trader is going to try to pick the top here. They're just going to trade the momentum.
Nor should they.
Momentum ceases. But outside of the swing trader to the longer-term investor, for example, valuation is constantly a conversation for long-term investors. And 3 months ago, on October 27th, at the base here of the low point here, Mark, the S&P, the forward PE ratio at the time in the S&P was 17. Today it's 20.3. You've had and just to give you some context of that, the last time you were above 20 on the forward PE ratio was, I want to say, February of 2022. You got above that level, above 20 forward PE ratio, I want to say summer pandemic 2020, when basically we shut down the economy. Price really started recovering, but earnings didn't initially because of all the stimulus we were doing into the market at the time. So the market responded up, but the earnings didn't, and so it put a pretty nasty valuation backdrop on the marketplace for pretty much for the most of second half 2020 all through 2021. February 2022, you basically came underneath that 20 forward PE ratio. And ever since then, you have been underneath 20 up until this previous week, when we now are above 20 officially in the forward PE ratio. Since October 27th, the S&P 500 is up a whopping, outlandishly impressive 21%. In that same time frame, the valuation of the market, as referenced by the forward PE ratio, has went from 17 to above 20. Now, what's driving PE ratios? It can only be price or earnings. And what's driving the valuation up here is because the market's up 21%, forward EPS projections are up a whopping 2% mark in that same time frame. And so the market is responding up, 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 up. But what we have not seen, and I've been talking about this for the past 3-4 weeks in pretty much all of our tackle trading content, is the market's going up, earnings are not going up here. And that is putting a valuation pressure on the marketplace. And again, it's not one that the short-term technical trader is going to be too concerned with. If I were to mention the forward PE ratio to Coach Frank, he wouldn't care about this conversation.
He would be very polite in listening to you while he was multitasking, doing something else.
He would not participate in the conversation.
No, he would not. It's like, I appreciate that. I'm going to trade this.
That's good info, Matt.
I'm going to trade this high base.
But to Warren Buffett, I'm willing to bet he does care about the valuation component and the valuation argument out there. So,
and this is what I find this such an interesting, it's a market nugget, right? You know, when you, because I really think it depends on your time frame. And my immediate reaction when you shared that with me pre-production was, all right, so swing trader's not going to care. Even a short-term position trader who's like trying to catch trends and manage them probably not going to care. That, you know, anyone with a long-term time frame is going to start paying very close attention to the macro backdrop, right? Because it is, we know in market, I mean, because you gave some good dates there, right? February 2022, that would have been a very good time to pay attention to the macro backdrop, right?
It would have. It would.
You know, and there are other times, you know,
right here. That's when that valuation started coming down, and so you were overvaluated at that point. But Mark, you lived above 24 P ratio for a year before you started seeing the ultimate weakness, and I think that's what that number does. It does not stop a freight train of the marketplace. When the market's momentum based and it's on a growth conversation and an improving economic conversation and a central bank, when are they going to cut interest rates conversation, it's not going to be laser focused on valuation in that moment. But eventually that valuation catches up to the conversation.
It always does. And everyone always says this time's different, and it rarely is.
Never different.
You know, because you need things.
I want to get your take on this because it doesn't stop a trend. Valuation will not stop a trend. Catalyst.
Yeah. You learned that early in your trading career.
Yes.
Oh, it's over. That's nice.
No. Who cares? Look at the moment.
I mean, like,
you have to understand what the conversations the market is having, but the issue that happens when you do get overvaluated is your spidey senses get up a little bit. And you know that you're going to have volatility pockets due to this. But it's just one of those things that I think it's more important for longer term investors who are looking at the valuation component, and they're probably saying, let me get a correction in the market, and then we can pick up better prices down the road a little bit.
I think that's
not the trader.
I think, and I think that's what typically a lot of, you know, investors who don't necessarily make day-to-day moves, right? Where they're like, oh, they're not swing trading their portfolio, right? But during times like these, they start to maybe cut back a few percentage points, right?
It starts limiting the participation pool is what it does. Because you now have long-term investors who are looking at the valuation component saying, yeah, these are better than expected earnings over the last couple of weeks, but do we feel comfortable enough parking XYZ money in XYZ stock for the next year and a half, 2 years? And I'm willing to bet that a lot of institutions are saying no to that in terms of the long-term analysis. In the short term, the market's going to do the same thing that you and I are looking at right now. They're not going to question the technical situation until a catalyst comes out to change that conversation. And until that happens, we're bullish and we're going to be pushing the price. But the valuation, once again, just puts it into the back of your head saying, okay, we are now dealing with overextended technical situations. We're overvalued from a fundamental perspective. maybe you start tapping on the brakes a little bit when you're thinking about anything outside of just a standard swing trade. And if we correct here, maybe we have a different conversation, but I just feel like as a short-term trader, you're going to follow the price and let the price kind of dictate where you want to see the market go. From a long-term investor perspective, you're not picking up stock today with the valuation where it's at right this very second and saying I'm going to hold for the next 10 years. Now,
maybe energy.
Well, no, there's spaces that have that conversation. Certainly, there's industry.
Maybe Ford and GM. Like, I mean, there's, and this is what it comes down to, right?
Yeah, but in terms of the broad market,
yes,
we're talking broadly speaking. If you like your favorite energy company that has a 9 PE ratio with a forward at 11 and
with a dividend yield of 5, and
different conversation, obviously. But we're talking broad market mechanics, and you can't discount the fact that you're above 20 on the forward PE ratio. And you can't discount the fact that the market is up 21% in the last 3 months, despite the fact that forward EPS projections are only up a paltry 2% right now.
Yeah, no, eventually that breaks. And one of the things, Matt, I did a study for various classes I did, because, I'm always in, you and I are students, right? We're traders, we're investors, we're teachers, we're educators, but we are also students of history, students of the market. And trying to glean information from history, like you and I both love it. It's the kind of things that we would do even if we weren't in our position as educators. We would be like, I'm curious about something, right? I'm curious about something, I was curious recently, what does the market do historically when you're in overbought conditions, right? Because we're in overbought conditions, and if you go to Investopedia will say overbought conditions basically equal bearish, and that's not what really history says.
That's not accurate, but
it's a misnomer to say the
market can live in overbought scenarios for months. It can't live there for years.
No, it cannot live there for years. And sometimes it only lives there for days, but it does not equal.
Just simply because something gets overbought is not an immediate indicator that you sell. No,
you should never act on that alone, ever.
The initial thing is it's a sign of strength and momentum, Mark. When something initially gets overbought, that's what creates overbought scenarios, is momentum of participation. And so it's not a negative thing. So you don't look at overbought being like, oh, this is now bearish. No, it's more of we tap on our brakes and we wait on better pattern recognition for the next go around on the next leg. It's a hesitation bullish analysis more than a bearish analysis.
And in examining, as many as the close parallels as I could, and I had a pretty large data set, there are almost no, I shouldn't say almost no, bearish outcomes do occur, but they are usually they're minimal compared to a wide variety. Your most common
pullbacks.
Your most and then there's been some market accidents that have happened because things have got too frothy, but those are almost impossible to predict.
And they also come on unknown catalysts, typically some degree of a black swan event that it's not on our radar. We're not prepared for it. It comes out and the market immediately prices it in. But the amount of times the market has been overextended, overbought, and just simple consolidation solves the riddle of overbought, overextended situations is far more likely than a massive correction to the downside.
Yeah, I know. Yeah, history says by far the most common outcome here is a grindy consolidation, slow drift up, right? Not dramatic. I mean, what was it again? 20% since October 27th, right?
21%.
Yeah, I mean, that would be unprecedented if we did that, right? From the remainder of the,
No, I'm not concerned about the market giving up and puking here. I don't. Is that any of your concern right now?
No. I mean, there have been market accidents where you have swift moves down, but they all, like, for example, I mean, they're just different times. Like even in 2020, in a monster trend, you had the short-term momentum collapse on itself for a few days that led to buying opportunities, right?
But any of the major pullback scenarios, Mark, those are usually catalyst driven that I'm sorry. I don't feel like we as a collective investor community should spend too much time worrying about the unknown events that could stop momentum.
No, well, it's wasted.
It's it's wasted
It's.
is
I
what it,
think you acknowledge it just, and it's just the basic thing is everything feels easy. Don't go out there and abuse leverage. It's basically what
well,
history.
I think the message is really simple. Don't get aggressive at the top end of an overextended range. But don't assume just because something's overextended or overbought or overvalued, depending on the scenario, that that's going to end the trend, because overbought and overvaluation conversations that we're having right now, they're not end of trend conversations, Mark.
No, and I think you just summarized it nicely. Do not get too aggressive when you're in these situations, but don't assume the trend's ending either. I mean, I think that's a good summary, at least from my historical study, and just.
Well, I see it very simply as this, Mark. In technical analysis, you have three basic patterns that you track in a trending condition. The first one you track is breakout scenarios. The second one you track is overextended scenarios. And the third one you track is retracement scenarios. Right now, you're in an overextended situation from a technical perspective. What would that suggest? That would suggest tapping on the brakes, and you're looking more at trade management on ongoing positions than you're looking at new entries from an aggressive perspective. From when you're looking at the valuation component and you're dealing with the 20 forward PE ratio, and in the last 3 months the forward FP has went up 3 from 17 above 20, but forward projections are only up 2% in the same time frame. You obviously are overvalued from a fundamental perspective, but does that stop the trend? No. That just stops you from doing anything from a long-term investment perspective when you're looking at a company that you feel is overvalued. And so you would wait for a better opportunity from a valuation perspective. But in neither one of those scenarios, when we're talking about either overextended from a technical perspective or overvalued from a fundamental perspective, does that mean that that's the end of the trend? That's not it. It means you most likely go into some degree of secondary pattern at the top end of a trend, maybe some consolidation, which is not bearish in any capacity, or a pullback, again, not bearish. I don't see anything bearish in this conversation. I don't see anything bearish in the technical conversation. I don't see anything bearish in the fundamental conversation right now. Do I see reasons for hesitation and consolidation and let the overextended nature of the market kind of work itself out a little bit in the short term? Absolutely.
Yeah, I think that's the base case right now.
But in terms of the market just achieved 5,000 for the first time in its history, and all of a sudden it's just going to puke it up, that's not what I see on the landscape right now.
Yeah, I think that's just a sensible base case right now. And and for the market to turn, of anything significantly, you're probably going to have a macro narrative change, and because it's a pretty favorable one for the bulls.
Let's talk about those macro narratives then for a second. Macro narrative number one, central bank, obviously. So the market was expecting to get 7 to 8 cuts. Now the market's expecting to get 4 to 5 cuts. You've had a revision against market expectations on the rate cut perspective, and the market still goes up.
Yeah,
like,
and you and I have talked about this on the halftime report a little bit. The reducing of expectations by a couple cuts does not change the trend of where the central bank is heading, right? No. And so it's not like, oh my gosh, they're cutting 5 instead of 7. Let's just all pat.
That, Mark, but I also think it's impressive that the market did not stop its trend or its patterns or its momentum when you had an obvious revision of less dovish Fed. Because again, when you're thinking 7 to 8 cuts, and now you're only getting 4 or 5 cuts, you and I are on that same page where, yeah, that's not a big difference in this conversation in 2024. But Mark, that is a big difference in market expectations. And if
it's massive.
At the beginning of February, hey, listen, over the next week and a half, we're going to revise our market expectation from 7 to 8 cuts to 5 cuts, we'll say, and the market's going to breach 5K. I would say no. And yet that's exactly what it did.
Well,
So
I think the market is technical in the short term until the trend plays
agreed,
out.
but again, these themes that we're talking about, that would be a bearish theme that didn't come to fruition in any capacity. So if it's not going to be the central bank and the market revising their expectations on interest rates, geopolitically, what else?
It would have to be the return of inflation
to stop the market, and it hasn't done it. Fundamentally, we just had a 15-minute conversation on valuation. That hasn't stopped it. Technically, we've been living in some degree of overextended nature for months in the market, it feels like. That hasn't stopped it. So what's going to stop it?
I think two things. One, inflation, if it ever returns, right, would
So an
shift.
if A then B scenario, variable type scenario, but that's not going to stop the market from this momentum.
No. All of these, I mean, one day, is one day arguments aren't going to stop anything ever. Bears have to. I always like to joke. Bears have to be right.
Okay, well then,
just an excuse.
And I don't think this is going to occur, but based on everything that the market from a bearish perspective has had it thrown at it this year, Mark, and let's be real. It's had a few bearish things thrown at the market so far this year. You've had a revision on the market expectation from an interest rate perspective. I know people are geeking out about positive earnings, Mark. The veracity of these EPS beats are still a very big concern for me personally. And even though earnings has gotten better, this is not an earnings conversation yet. If it was an earnings conversation, the forward E in the forward PE would be up more than 2% in the last 3 months. Would you agree with that?
Yes.
Okay, so earnings has been
that one's not debatable, right?
Yeah, earnings has been an improvement. There's no doubt about that. But earnings is not a positive catalyst for this market right now.
That's not what's driving the market.
I don't think so, because you've had many scenarios in the last 2 weeks where you've had an EPS expectation of 75 cents and it comes in at 76 cents and you're up 8% on that announcement. And I said this a couple weeks, I'll say it again today. It almost feels like the market has accepted the economic improvement argument. They've accepted that we've found the pinnacle, the terminal of the interest rate. We're going to get cuts this year. And as long as earnings were not absolutely disastrous, they had the macro dialed in necessary to push that buy button. And that's what you've had. You've had an improvement from an earnings perspective, but I don't think anybody should be making an argument that we have an earnings, a positive earnings conversation yet. It was better than expected, but the expectations were extremely low. And even the blended growth number is probably going to end somewhere around 3 to 4%, which is a really good improvement. But again, it's not as big as what we expected coming into earnings season, expecting somewhere around that 4 to 5% blended growth number. So I don't know. I think the best way to navigate this market when you're looking at it is from the pure technical perspective.
I think you have to right now because, one of the, and this is a deep belief I have, is that markets and stocks always get to where they should be, like up, down, all around. Like as far, there's the efficient market theory.
Over the long
term, eventually things get to where they want to be. But short term,
long haul's decades, not years, by the way.
Yeah. But short term, things can overshoot. They can undershoot. That's very common. That's not a radical stance of mine, right?
Think about what Alan Greenspan said in a famous speech in 1998, irrational exuberance, right? Mm-hmm. When he was trying to describe the froth in the marketplace in kind of a very similar conversation to what we're having right now, right? Improving conditions in this, a little bit of deterioration here, But there's an argument to be had between the bull and the bear from a fundamental perspective in the market. Would you agree with that?
That is the legitimate conversation. Is
There's an argument.
What are you willing to pay?
But technically, there is no argument.
You know,
technically, you have bullish on bullish on bullish situations. Okay, so in 1998. Alan Greenspan gives a famous speech where he describes the market and the market participants as irrational exuberance. I think you could describe that a little bit right now. But Mark, it took 2 years of that irrational exuberance to play out in the marketplace before we went through the dot-com market sell-off. These exuberance can last far longer in the market than you or I think it can. Markets can live in overextended areas of the market for months and months and months and months. It can live in overvaluation for what can feel like months to years sometimes. But it does give you a little bit of concern. But again, it's not something that stops you. I just feel like based on where we're at from a valuation perspective, based on where we're at from a central bank conversation, I think the only way to navigate this market as of right this very second is from a technical reading perspective.
Until something comes in the conversation that's obvious, right?
Yes.
Until something comes in, I was like, oh, we need to discuss this, and I guarantee we will catch that before anyone. Let's
see if we have those things happening this week here, Mark.
Well, I don't think so, but let's go over the week that's had. Besides Taylor Swift being shown under 10 times on the Super Bowl, that's where the week starts for me. I'm recording.
The over under is on that. I am taking the over.
I got Gino on the hook for 10. So and I'm putting that in my trade journal.
I don't think the over end on Vegas is 10. I don't.
No, listen, you know your brother. I got a bad line and I jumped on it.
You did. You pulled a me. You gave him a fake line and you saw him getting.
He was so excited about Taylor Swift being
like a trader trying to look at Zoom at $600, getting so excited. And
Gino's very cautious. Like with his money, that's right. He's been a successful trader.
You saw excitement.
I knew I couldn't. If I tried to push the bet too much, he was going to back out. But I knew I could get him for $10.
It was a good job by you. That was
if I tried to push 50, Gino would have been like, oh wait, what's up?
He'd been like, no, I can just.
There's something because Gino's spidey senses would have went off. His
spidey senses should have went off on the line there. But this week, I think you got it. Do you have the week necessarily to stop a freight train of the market right now? Probably not, but you do have it. It's sneaky, important week economically. Economically, last week, Mark, we just did not have a lot to really talk about. It was a big central bank speech week. And let me summarize it. Jay Powell gave a speech on 60 Minutes last Sunday. Every one of these Fed members gave the exact same speech throughout the week. You agree?
No, they were on. Oh, they were dialed in. We're on the same freaking. Every once in a while, you'll have a few people go off script. It's almost like they're testing the waters.
A little bit.
Or they haven't re-coordinated. They were coordinated this week.
They were dancing the same dance. There's no doubt about that. And Powell's message is one of second half interest rate cut. That's what the central bank speeches kind of laid out this week as well. And so that was basically last week. You do have improving conditions in ISM readings, both on the manufacturing side as well as the service side. But last week was not really a economic week. We really, even on ISM services last week, Mark, I think you and I spent like 3 seconds on that analysis on Monday before we moved on. This week's inflationary week. You got CPI report, you got the PPI report this week. Those two coming in on Tuesday and Friday respectively is going to take all the oxygen this week. Obviously, anytime we do have CPI week, that's going to be an anchor. That's going to be the number one economic report we anchor against. But Thursday this week is one of those that it's going to sneak up on you a little bit. and especially in some secondary data that I feel is going to become more and more important this year. I don't think inflation is going to become a more and more important conversation this year. Most of the intermediate to long-term projections and trends right now see inflation coming down throughout the year, achieving the Fed's 2% goal by the end of 2025. Speaking of inflation, did you see China's inflationary situation right now is actually going into a deflationary camp? If it does, it's going to be damn near impossible for that Chinese economy to get cooking. So the CPI report this week is obviously going to be important. But I think the Empire State Manufacturing Index, retail sales, the Philly Fed Manufacturing Index, industrial production on Thursday, not just one single report on Thursday, but the bulk of all of those that kind of come out at 8:30 p.m. Eastern Standard Time. That to me is going to be a really important moment for the market this week. It gives us a lot of the manufacturing, industrial. I do think both of those conversations start to pick up in the market this year. I think PMI numbers become an important metric this year. PMI numbers were not last year. PMI numbers were not the year before. Industrial manufacturing data was not necessarily important in the Fed conversation, in the inflationary conversation. I think as the Fed takes a back seat, as the inflation situation takes a little bit of a back seat, these manufacturing and economic sensitive reports become a little bit more important in the conversation. So I do think Thursday's an important moment for the market. But in general, you got CPI on Tuesday, PPI on Friday, and then a host of economically sensitive reports coming in on Thursday.
Yeah, and so it's really hard unless something shocks right now, right? To change narratives, right?
Yeah.
And so you keep an eye and you outline these. Obviously, the CPI report, it's hard to see the CPI report be dramatic one way or another this month, isn't it?
It hasn't been a dramatic conversation. Last month, what was interesting was we actually had a bump up in inflation last month. You saw that little bump up that we saw last month. It's kind of starting to get sticky in that 3% conversation. The expectation is for it to come underneath 3 again into that 2.9%. PPI report, if you'll remember, last month was pretty good. CPI reports following suit with a little bit of drop in that inflationary pressure, but you are getting sticky around that 3%, as you can see over the last 6 months. Mark, we're kind of averaging right around that 3% over the last 6 months, and that's kind of one of those zones that we always felt you were going to get a little bit sticky. It's starting to show its stickiness there. So it's going to be interesting to see if we do get underneath that 3%. The expectation is for total CPI to get underneath that 3%. And again, that 3% is year over year numbers. Those year over year numbers are usually as important as the month over month numbers, which are basically flatlined from last month to this month. So you do have an expectation of pretty sizable expectation of the year over year numbers improvement, but the month over month is supposed to be a little bit of maintenance mode from last month to this month.
Yeah, no. So, I mean, obviously we will follow the narratives and all of that.
What would you say is the most important economic report this week for you? Is it CPI on Tuesday?
The monthly option expiration.
That's not listed.
Well, no, it's just because, and this is, one of the things is every once in a while, some funky things happen around option expiration. Most of the time they don't, right? But every once in a while,
That's kind of like me asking Frank a fundamental question and him answering in a technical answer.
Yeah, no, it's like, because I don't know if things can shift the narrative or help form future narratives.
Thing on the docket this week that can change the macro narratives.
Well, it would be
improvement with inflation coming down. Soft economic landing allows the Fed to cut interest rates in the back half of this year, not because the economy is weak, but because the economy is significantly strong enough to take to bring, or not the economy, but inflation has been reduced enough for the Fed to come out of restrictive territory. Is there anything this week that can change that macro drop?
Every one of them can not change 1 week. They can help start seeding doubts, right?
The only thing it does is change the conversation of, okay, cut in May or cut in June.
But I mean, here's the kind of decision. Let's say retail sales is terrible on Thursday. I don't expect it to be, but let's say it was. Well, bulls are going to be like, well, we're going to get more cuts.
Like, the bulls cheat a little bit.
Like, we're going to get more cuts. Let's say it's really strong. Well, holding up in the face of higher for longer, like right now, like, man, they have their cake and eat it too a little bit, Matt. Like
20% in the last
the only thing that they can't have their aim is if you saw inflation surprise to the upside. That's a hard one to spin, right? That's a hard one to spin. They can ignore it. It doesn't mean
with the expectation. Think about it like this, though, Mark. With the expectation, because last month's year-over-year number was 3.4%. This month's expectation is 2.9%. So let's say we even get a miss, 0.4% on core. CPI comes in at 0.3, and year-over-year CPI comes in at 3.1%. That could happen this week easily.
Yeah, that's not an crazy scenario.
Does the Bears come out and party on that scenario?
No, dude, you got too many moving averages.
Okay. Or do the Bulls say, well, last month was 3.4% and this month is 3.1, 3.2%. So it's tough to see the one data point this week.
It just is
changing the conversation. It might weaken the arguments, right? It might weaken the argument, but I don't think it changes the data.
I think you're at a point, Matt, barring some macro thing where bulls it's going to be bull on bull crime. And you know what I mean by this is like, all right, I'm in. Oh, then there's a market hiccup. Maybe you have a 2-3% pullback, and
you're describing a bull market, bro.
Yes, and you have some.
That's what the bull market is. One area of the market catches a little bit of momentum based on an earnings report or an economic report, and that space catches momentum, goes up, gets overextended, and then all of a sudden what occurs? The buying stops there because it gets overextended and they rotate to a different area of the market.
Well, we'll see if they're capable of rotating. We haven't seen a lot of that this year.
No, I'm saying that's describing bullish conditions, though, when
it is
overextended nature of the market consolidates and that money goes into other areas of the market in the short term. That's the bull on bull crime there. And that's kind of what we're seeing in the market, not just over the last week or so, but I mean, these trends are certainly long enough and consistent enough. We've been parked in bullish territory, Mark, in the Tap and Trade newsletter for months now. It's a very consistent backdrop. So I just feel I feel the best way to approach this right now is pure technically.
Yeah, I just think, yes, I agree 100%. I do.
With an understanding that with the valuation of where it's at, you're going to get volatility pockets here. Where
I like that phrase, volatility pockets.
I'm using it from now on.
It's a good because it is a perfect summary of the history study I did. Is that you to get prolonged bearish conditions from this point, it just doesn't happen in history. Like for but you do get volatility pockets. I didn't phrase it. I called them hiccups.
I gave the analogy in
volatility pockets sounds far more sophisticated.
It does sound sophisticated. Thank you. We're going to go with it. Volatility pockets, Tackle. That's what we're going to describe for unexpected volatility within the backdrop of a bullish uptrend. That's volatility pockets.
Where your trader's like, well, what caused that to go down? Well, nothing really. Yeah, sure. The headlines will say something.
Overextended.
But it's bull on bull crime, dude.
Bull on bull crime. It's not a bad thing. That's not a bad backdrop. You
buy those volatility pockets, by the way.
Bull on bull crime is my favorite market. What are we talking about?
Like if you get hiccups, volatility pockets, you do buy those.
I guess for me, Mark, I'm not sick of the debate of the macro. You and I never get sick of the debate of macro. We love having these macro conversations, these macro debates. But I do think the market's exhausted of the central bank, the soft economic landing, the inflationary conversations. I do think they're exhausted. And I do think there is a legitimate debate between bulls and bears from an economic perspective, from a valuation perspective. And when you can have legitimate debates, that's great. It makes great content. But Mark, the best way to navigate the markets is not to have an internal fundamental behavioral, geopolitical debate. It's just to focus on the backdrop of the technical analysis. If you are categorizing, and this is not my bias or your bias or what our rankings are at Tackle Trading.
Dude, my bias is make money.
But if you as an individual investor are looking at the macro backdrop, and you're looking at the fundamental backdrop, and you're looking at the inflationary backdrop, realize we've been having these conversations for 3 years in the market now. The best way to navigate this is from a pure technical perspective,
with the understanding that our new favorite phrase, volatility pockets, are more likely than they would on an average. They are more
likely than at the beginning. At the beginning.
At the beginnings, yes. I think that is a 100%. Good.
But if you categorize a trend as a bullish uptrend, and it has a multiple time frame situation, meaning the daily chart and the weekly chart are both trending in the same direction, you're never going to go against that, ever. The only way you treat that is from a pure technical perspective. We just broke out of 5K. We're overextended. We know we're going to get some pockets of volatility, but we're still looking bullish, bullish, bullish. And so until that changes, until we start seeing pattern development at the top end of the trend that suggests slowing momentum, reversal analysis, this is a bullish conversation.
Let's talk. Let's just spend a couple minutes on gold and oil. Last week you titled the podcast "The Oil," and then I guess they listened, like whoever they are, because oil had a really good
powers that be listen to the podcast. I know that.
The oil had a really good week, but here we are, kind of where we were a couple weeks ago, right? Still have our support level, still have the macro case. Still have resistance areas, but man, and I don't want to belabor it because we spent a lot of time on it last week, but man, all of that macro conversation sure does make a good macro case for oil.
Well, are we talking? Do you want to go oil or gold first?
Let's go oil. Let's just go oil real quick, and then we'll bounce over to gold. So
I think with oil, again, the number one thing you've been seeing, the number one most confidence in a support level in the marketplace, and I'm not talking about me, I think it's a market conversation, is the 200 weekly moving average. That thing on oil has been so bloody important to the analysis for a very, very long time in oil. It does not want to close. It came into last week with a bunch of heat, Mark, a bunch of heat. It came in with it was a Falcon rocket. It was a Falcon 9 rocket ship the week before, just got blasted right back down the week after. And what did I say last week? Oil stands alone. My general point is listen, this support level is extremely, extremely important. And if we ever get a close underneath that level, that is going to be a significant change in behavior. But until the market closes underneath the 200 weekly here on oil, I think we look at it as the strongest support level in the market. So I'm not surprised that the bulls came out and supported oil's pricing last week. I was a little bit surprised, one of those volatility pockets from the week before in oil. That's what I kind of feel we went through. It's impressive to see it fight back up. But the reality, Mark, is this oil saga, for us to get that energy conversation that I think we both want and we both think we're going to get, we need to see more than support hold here. And that's where we're at in the oil conversation. Oil's got to break something and hold. That's what it has to do. And here's the beautiful thing about that is, Mark, because of the consolidation over the course of the last few months of oil sitting around the 200 weekly moving average, you are now had these longer duration moving averages on longer term timeframes, such as the weekly chart. They're now all converging against right around 77.5. Last week, I called out a number in the podcast. I called it out all week long in the halftime report. Oil gets above 75. That's an improving conversation. That's what oil did last week. Now you look at the 77.5 zone, And that's kind of on that weekly chart where the 50 and the 20 moving average are kind of converging with one another. You look at that 77.5 zone, you say, okay, if I can get a close above that, that's a significant change in market mentality. And then the last zone would be 80 before you start looking at a little bit of open air type scenario. And so you're now in a zone between 77.5 and 80 that has significant resistance levels to it. Not as strong as the 200 weekly moving average underneath supporting oil's price, but they are certainly zones that we have to give respect to. And so if you're looking for that power move in energy, for example, which energy quietly has had a pretty decent earnings season itself. It's had one of the better.
Well, you haven't been quiet about it.
From
you've been
as perspective, revenue, I'm discounting right now. But again, if this is going to give us not just a swing trade here, Mark, I'm not having this conversation on.
Yeah, we don't care to try to make a quick buck on a swing trade.
It's trying to catch something a little bit longer term there. I do think you can look at the combination of one or two things. Number one, we got improving conditions, no doubt, but ultimately confirmation is going to play a role here. I think you can be a little bit more aggressive than the two numbers I'm going to call out, but I'm going to call them out because ultimately that is where you do get some degree of confirmation on the space. I think at 80, anything above 80 here is open season. It gets into an open air environment from a multiple time frame perspective. You got to have a healthy dose of respect between 77.5 and 80 on crude oil. And then when you're looking at energy, we did put an energy component MPC on our scanner report this week. But that was more of an MPC, not an energy conversation. MPC had a great earnings season. It had a great secondary setup. It's got a high base on a breakout. If you're looking at energy, I think the combination of 86 on XLE plus 80 on crude oil, that to me, you finally get into open air. Anything underneath energy on underneath 86 on energy, you got to be having the front running philosophy, which means you're going to cut position down, treat it as volatility playbook, make sure you're being very cautious, very conservative. But I do think if you do achieve those two simple numbers, and I don't think it's going to happen this week, but I do think above 86 on energy and above 80 on crude oil, those are the two zones where you do get into open air. You have no open air underneath 86 and you have no open air underneath 80, which means anything you're doing in energy, anything you're doing in crude oil, it's got to be a front running philosophy, which is going to be very similar to how we treat volatility playbook from a short-term analysis perspective. But that's how I would see the backdrop of energy in combination with crude oil. In general, the fundamentals of energy are improving. Obviously, it's always a crude oil saga with oil, but it is an improving backdrop. We're still in the middle of the story though, and so I hope those numbers help people navigate this because there is some chop right now.
Yeah, no, it's been a really good cash flow environment.
Oh, cash flow's been playing for months.
What has not been a great cash flow environment have been the gold miners. I know they've been weighing on my portfolio performance to start the year. Gold's been fine, right? Gold's been doing nothing, but those gold miners have had a rough start to the year.
Yeah,
but gold itself has been just doing nothing, right? And
so what's real for you?
the gold doing nothing. Listen, like Friday's a good example.
Mm-hmm.
For whatever reason, oil was up, gold was down a smidge. Algo programs came out viciously on Friday morning. Let's short gold miners, let's short energy stocks, let's short FC. Why? I don't know, right? But they came out.
Chinese economic data wasn't great, but
and so let's punish them for the day, even though the underlying commodity isn't doing anything, right? Type thing, and we see those every once in a while. It's just, I mean, I don't think there's a lot of excitement right now in gold, but dang it, Matt, every weekend, this is the third straight week, by the time I get to this podcast, I'm like, this is just impressive. Like, even though it's not doing anything.
Because, like, for somebody who doesn't know the gold markets in comparison to the S&P,
Like, it's just impressive.
it'd be like, what are you guys talking about? It's like choppy between 2K and 2100.
It's done nothing all year, the gold.
Because we're very impressed because, number one, it's never, ever, 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 ever stayed above 2K like it is right now. That's number one. Number two, based on the improving economic condition and based on the S&P 500 going up 20% in the last 2 months, gold should be at 1900.
Yeah, and the fact that it's done nothing is what is impressive.
GDX is telling the truth in comparison to the marketplace, Mark. But that should show you there is tremendous amount of confidence by the gold investors on gold right now. And for those of you just catching this gold conversation, we were impressed right here. We were impressed right here. And so getting gold back up above 2K was obviously an extremely important step in the right direction. But the stabilization we've seen above 2K, I think, is the thing that you and I are most impressed with in comparison to the dollar breaking out and the S&P going up 20% in the last 2 months. Mark, if you were going to tell me S&P up 20% in 2 months, dollar's going to break out and gold's going to stabilize, I'd say you're crazy. You're absolutely crazy. You're off your rocker. And yet that's exactly what has transpired. And so I do think it's impressive that gold has maintained the discipline above 2K. But this is what we needed to see for that 2K to become that next final stopping point in any support levels. And so we're still kind of going through that conversation. GDX, obviously, a lot of the cash flow traders at tackle trading, they have their gold stock. They do covered calls on it, boomerangs, whatever it is. It's not been a great cash flow environment. It's been a cash flow to offset loss environment, and that's not the best environment. It's better than
that's not how you want your cash flow day to be, but it's what you have to do sometimes.
You want your cash flow to compound. You don't want your cash flow to offset loss, and that's exactly what has been happening in the gold markets. And that could happen again this week a little bit. You're dancing a little bit of a major support test. Newmont Mining broke support. Barrick Gold has earnings this week. You could deal with some volatility. I think we've been right on the analysis. Cover if you got it. I think you're still covered. Your numbers are getting lower and lower on the cover. 29 was my number last week. That's not my number this week. It's going to be 28. What about you? Because you just can't cover at 31 going into a frustrating.
Well, you're just not going to get any credit up there. I've stopped using covered calls, and I've added put calendars to my positions. Because the one thing I'm not going to do is lose my shares because something happens and the price movement so fast and I don't get. So I've put on some cash flowing put calendars that benefit.
Hold on. You're saying a lot of things people don't understand.
You're right.
We're going to have to.
And I'm usually better than that.
No, you just said a lot of things. 90% of our listeners, I don't know.
All right.
So
good call out. Good check.
Let me set it up. Hold on. Calm down. Let me set it up. So the typical way to offset loss in an asset class that you do covered calls on is just to be aggressive.
Just covered calls.
That is the typical response. That's what I'm doing right now. You did something different though, and what you did speaks volumes to me, brother, by not doing the covered call and doing a married put instead. Talk to me about why you did that, because I think it's an important conversation. So why is it that you reduced the exposure of the covered call and instead of using calls to offset loss, you added a put option instead?
All right. It's a little complicated. One, let me try to simplify it, and I could talk for an hour and a half on this one position, why I'm doing what I did.
This is a coach's show topic.
Yeah, but okay. I take technicals into account, but I take macro into account a lot, right?
Yeah.
That about me. Anyone who knows anything about me knows that's the combination. A lot of macro and then technicals. On the macro side, we got a banking crisis where banks are exploding. All right.
Regionals. Yeah.
Yeah, we got regional banks exploding. They will.
Inlet, Powell, they've all admitted there's going
This
to
is not a conspiracy theory. This is public knowledge.
be right now is literally exploding. Yes.
You have a commercial real estate crisis that is brewing where the data is starting to pile up. Now, we could do a whole podcast on these subjects, but these are known subjects. This is not
two heavy pockets of nastiness would be if the Bears were looking for some catnip this week. Regional banks and commercial real estate crisis. Those are two real big bear talking points.
Yeah. Now, and because of the nature of these type of things, the news on this type of flow can flow fast, right? And so it doesn't make any sense to me on something like gold, because if those crises develop into actual crises instead of isolated cases.
Out of 2100.
Gold's breaking out at 2100, and gold miners are going to catch up in a freaking hurry.
Gold will be gold miners in a scenario where we have a regional banking crisis. We do not have to go far. Just have to go
gold
back.
Miners are at $36 before you can blink an eye.
And Mark, that's exactly what happened last year when Silicon Valley imploded.
And so this is
from 27 to 36 in a straight line.
Yeah, so this is not,
that very well, because my covered call got blown out of the water there.
And so, I don't want to pick up pennies because I can't get great credits at the strike prices, and some strike prices I can't get any. So I can't get great credits, and so I'm like, screw that. It's just not worth it, giving what we know about the macro backdrop. Mm-hmm. But I have to respect technicals, and I have to try to, put myself in positions, because banking crisis might not just be a full-blown one. It might be an isolated one. It might not create anything. So
community bank, for example, is not as large or as important as the Silicon Valley conversation.
And so I got to respect the relative weakness, and I got to respect the technicals. And I got to because I can have all the opinions I want, but the thing I do well, despite having whatever opinion I have, is managing my portfolio. To make sure I'm never put in positions where I have to deal with nonsense.
Yeah.
And so I've added these little put calendars that if we get slightly bearish neutral conditions, I can find a way to cash flow the position. And they were relatively cheap. And so that's the route I did, respecting the macro. Oh my goodness, some stuff could blow up. Gold could be at 2,300 real quick, and goodness, and have some outside appreciation, but balance it with some really cheap put calendars, because they're really cheap right now. Puts on everything are cheap right now. You could do just about anything.
The options are cheap right now.
Yeah, put options are just.
That's why you're complaining about the covered calls, because options are cheap right now.
And so doing a thing now, if gold miners were just to collapse here, these little put calendars don't really benefit from that situation. They don't hurt. But if gold miners just collapse, then I'm like, well, I believe in gold long term, and then I'll cost average down if that happens. So I kind of went through all of the scenarios in the market, and because it's for me, it's not as simple as I just have to sell a cover call and I have to do it. I think you take the totality of the situation. I think the totality of the situation indicated that maybe you don't want to be as aggressive, but find a way to creatively manage a position. So that's where I got some of the reasons on that one position why I'm doing what I'm doing.
I don't mind it. I mean, if you have a little bit of concern that we're at a zone that we could see a V shape, and Mark, overextended in the market, pullback analysis, New York community bank caters. It wouldn't take a lot to light this spark here, right?
Yeah.
And so let's say we start looking for a pullback in the S&P, and that pullback is based on whatever the regional bank situation is right now, getting a little bit worse. All right. In that environment, GDX could go from 27 to 29 in a heartbeat.
Oh yeah, overnight.
It could gap there.
It could gap to there.
And if you're covered at 28, if you're not aggressive on the management, you could be called out at 28. And if your average price, say, is 31, which mine isn't, but if that is what yours is, you might not want that.
Yeah.
right? And so you might want to be either one, you got to be, if you're doing cover calls on gold, I appreciate this conversation, by the way. If you are doing cover calls on gold, I do think in the back of your head, you're a little bit more conscious of the management and willing to buy that option back at a loss on the call side if you do get that spark back up. I do think you're in a zone because 27 on GDX, and again, this is technically here you'd be looking bearish, but again, this is an instrument you and I both know. This is a zone that has played out as support multiple different times, including a nice little fake out just 3 months ago on the marketplace. If this zone holds, I don't think you and I are surprised. If this
no, you shouldn't be, right?
Like I think the most likely scenario is this zone.
I mean, gold's holding. I mean, it's not like gold's going to hold 2,000 and GDX going to go down to 17.
No.
That's just not happening.
No, but I also wouldn't have told you 2 months ago GDX would go to 27 if gold has maintenance mode above 2.
And that's why you have to take into account all kinds of factors. Right?
It's been fascinating to watch GDX and gold miners separate from gold itself. They do have a tendency to separate. They go with kind of basic materials more so than with gold oftentimes, but I'll tell you, I still believe there's going to be a moment here this year where we're going to get some significant catch up in GDX.
Well, let's call it what it is. You don't go through the fastest hiking cycle without there being some consequence somewhere, right? We're seeing that.
Yeah.
And Jamie Dimon's like, yeah, I'm seeing it too. I'm going to buy some banks this week, bro.
We're looking to buy a few shares of gold miner stocks. He's like, no, I'm looking to buy
Jamie Dimon's like, I'm going to buy a bank.
Yeah, I'm going to buy me a bank on Monday.
And I ain't paying the price it's listed at today.
No, he's going to get the Fed pricing on that.
Oh my goodness!
I do like the call out on the gold analysis, Mark. It's at a zone of importance. Let's track that 27. I think if you are covering, like I said, I called out 28 for a reason. It's right where that 40 delta 30-day contract is. That's how I see it right now. But I also would not be surprised if at this zone of 27 we start to see gold holding. But then again, we've had gold stocks on our bear watch list for the last 2 weeks.
All right, let's get to our Super Bowl celebrations, man. Give us some final thoughts. Let's wrap us up.
No Bitcoin, none. No,
dude.
None. No dollar. You are so at Super Bowl Sunday mode. I'm fine with it. I'm fine. Getting into too.
I think there are more interesting conversations next week on those two particular topics.
I do as well. I do as well.
I'm in the mood to start eating nachos.
I love making me a dip.
What are your Super Bowl snacks?
That's good. Let's have that conversation. I always make. I'm a dip connoisseur.
Yes, me too. I'm huge.
I love making dips. And my dips are a lot of random stuff get thrown in my dip. It's a little goulash of dip beautifulness. I'll start with the Velveeta base today. I'll add in a little bit of hamburger into the Velveeta base. We'll definitely do some salsa and kind of bring it a little bit of a combination platter there. Definitely going to have chips. Got to have the tortilla chips as well. So I'm going to do a Velveeta spread dip base, a nice little queso type dip. Probably do a cream based dip as well there, Chucky. We're definitely going to do it the right way for Super Bowl Sunday with the dips here. But I'm a big dip guy, far more of a dip guy than I am like a buffalo wing guy. I'm a chips and dip Super Bowl guy. What about you?
I'm chips, dip, and some more chips and some more dip.
Yeah. That's
like
Justice Household 101.
I love it. And so then on Super Bowl, you oftentimes get extra toppings, right? You can put some olives, you can put you get some extra special guac, right, and then and then I like the general cheese layouts on Super Bowl, right? Cheese and crackers to go along with that. So
all right, give me your score there, brother.
5
hours from now.
27-24 49ers.
I like that score. That's close to mine. I'm going with 30-24 Niners.
Oh, so we are right there in like, yeah, they're
Good game. Good game.
I mean, you can see that seems like a reasonable outcome, right? Like,
30 to
like,
24. That's mine. 30 to 20. 30.
All right.
I thought about 30-27, but I'm going 30-24.
All right, send us out, bro.
Yeah, if you love the podcast, best way to help us on the podcast, give us a nice little 5-star review there on iTunes. Coach Mark and myself, we love to have these conversations in the halftime report every single day on our Tackle Trading YouTube channel as well. In the podcast, we'd like to have it more of a open-ended conversation. In the halftime report, we obviously like to dial this in from a charting and a technical perspective. So if you want to join a community that's going to help you navigate the financial world on a day in, day out basis, Tackle Trading is that community for you. You can go over there to our Tackle Trading YouTube channel and just subscribe to our YouTube channel. We go live 12:30 p.m. Eastern Standard Time every single day in the halftime report. We also do a lot of other educational stuff in the YouTube. But if you're ready for the Tackle Trading Pro community, get over there to tackletrading.com and you can sign up for a 15-day free trial of all the goodies our pro members love at Tackle Trading, including our scatter reports, stock options, commodity report on Saturdays, Tackle Trading newsletter over the weekend, and then over 10 different webinars every single week with the coaches of Tackle Trading, helping our community navigate this financial world together. So with that said, I hope everybody has a wonderful, wonderful rest of a beautiful week. And last thing, the Monday after a Super Bowl should be a federal holiday. Let's get that working.
It should.
It should. It just should. Everybody celebrates it. Mark, what about you? Final thoughts?
Listen, just, I like Matt's pay attention to the technicals, but be aware of, what did you call it? Pockets of volatility?
Volatility pockets.
Volatility pockets.
I've called it pockets of volatility, but volatility pockets.
I apologize, but volatility pockets have more frequency in these conditions, and so be aware of them, right?
And again, those conditions are typically the combination of overextended technically, overextended fundamentally, volatility pockets, increased probability in those environments, and that's the environment we're currently in.
Yeah, so just, be aware of that in your tactical plans, right? So everyone, but yeah, have a great week, everyone.